What's up, guys? It's John here again. Are you looking to level up your investing game with options trading? Today, we're diving into two powerful yet beginner-friendly strategies: cash-secured puts and covered calls. By the end of this video, you'll know what they are, how they work, and which one might be right for you. Before I continue, guys, if you find this information useful, then please don't forget to hit that like and subscribe button, as this will help me out immensely. Also, remember this is not financial advice, and this video is made for educational purposes. Now let's get into it. So what are options exactly? Options are contracts that let you buy or sell 100 shares of a stock at a set price before a certain date. You have the choice at the expiration date to buy, sell, or do nothing. In simple terms, you just ride out the entire contract to expiration. A cash-secured put involves selling a put option on a stock while setting aside enough cash to purchase that stock if necessary. In my opinion, this is the safest choice for beginners. Think of yourself as a casino. You are betting that the price will go up, and eventually, the person who thinks that price of stock will go down will lose their money. The primary risk is that if the stock price falls below your break-even point, you may be required to buy the stock. Although this scenario is uncommon, it is still a calculated risk that you should be prepared to take with any trade. Let's do a quick cash-secured put calculation for Rivian.
So let's look at a cash secured put for Rivian. So let's go in here, build cash secured put. Okay. First of all, you want to make sure that you are seeing a cash secured put here, because if you put in the wrong order, you could lose all your money. So let's assume we want to go with Rivian, which is not very volatile. It's what IV implied volatility is 79%. That's okay. That's a good stock. You're not going to make a lot of money, but you will also not lose a lot of money. But the point here is you never really want to lose because the chance of profit is so high. Okay, so we choose Rivian. Today, let's assume that Rivian's price is $4.21. The day I'm making this, the markets are closed. So the price is not going to change so much. So it's a good day to demonstrate. You assume that on February 7th, 29 days from now, the price of Rivian is going to drop to $11 or $11.50. What happens now is that you will need $1,150 in your account because one contract is 100 shares, so 11.5 into 100. The credit, the money you will make is $17.50, so this will come into your account. And the chance of profit is 87%. There is a little more to this, but in this video, I'm not going to go over it. I will explain that in a separate video, how to choose your cash secured puts. So let's assume that you bought your cash secured put at $14.21, and tomorrow, Rivian's price jumped up to $18.30 or $18. So you would have already made almost all your money, eh, you know, excluding the 50 cents. In this case, an experienced trader would sell, because what's the point of holding on um, to an option when you've already made 99% of the money? Now you must be wondering, what's that red section in the bottom? Okay, let's go over it. The good thing about cash secured puts is that it has time decay built on it. Now, unless Rivian goes all the way down to 10, you are going to lose money. But that is generally not the case. So Rivian might say, let's drop down to 12 because it is a big company and it has a lot of cash. So yes, until February 4th, you will be in the negative. But once that's done, once you're past that, you will end in the positive after 30 days. And if you meet this break-even price, let's say, on the day your contract expires, you will be assigned those stocks, which means you will be forced to buy those stocks. And that's okay as well, because there's another way to get rid of those stocks and still make money. So, my main point is it's really hard to lose in cash secured puts because there are ways where you can actually make your money back. But for this video, I'm just going to keep it simple. I'm going to show you what a cash secured put is and what it looks like on the day of trade.
So what is a covered call and why go with it? A covered call is when you already own 100 shares of a stock and want to use them as collateral to make extra money. This strategy is effective if you believe the stock will remain flat or experience only a small increase. However, the downside is significant. If the stock price surges, you'll have to sell it at the strike price, which means you'll miss out on those potential gains. Consider yourself as a casino. You believe that the price will remain stable over time, while the person you are selling the contract to thinks that the price will rise. If they are proven wrong, you get to keep the premium they paid. However, if the person you sold the contract to is correct, you will be compelled to sell your stocks. The good news is that you can often benefit from these situations, so it's not all bad. I advise against using this strategy unless you own 100 shares of a major billion-dollar company, such as Google, Amazon, ASML, or similar firms. Now let's do a quick calculation for a covered call. We will use Rivian as our stock.
So we are on the covered call page for Rivian. Let's assume that the price today is $14.21. And on February 7, you believe that the price will rise to $16. Now remember that the higher you go, the less risk there is. Hence, the premium is a little bit low. But the closer you go to where the actual price is, the premium is high. And if you draw this further out, the premium is even higher. But honestly, you just don't want to go past 15 to 30 days. That's where I would keep it. Just because you're holding the stock, and if you need to sell the stock, then it's going to be difficult for you. But in this case, let's go ahead and choose $7. And you believe that the price will rise to $16. In this case, the premium you will earn is $50.50. But also note that you are holding 100 shares of Rivian, and the price of Rivian in your account will be $1,421. And if Rivian goes down $400, then this $50 credit will help you, but it's not going to recover the $350 that you've lost. Also note that with covered calls, the chance of profit is always hovering around 50 to 60%. So this is a riskier gamble. And in this case, the break-even price is $13.71. So this means that as long as the price remains over $13.71, by the expiration date, you will make some profit. But if it goes below $13.71, you will immediately lose $10, 30, 60, 90, 120, 150, 170, 200, and 230. So covered calls are very risky. I advise against them unless you are holding a stock like Apple or Nvidia or ASML, something like that. But most people aren't exactly holding 100 shares of those expensive companies. But if you are, good for you. You can follow this strategy with those stocks. But with something like Rivian, I highly advise against it.
Which strategy are you excited to try? Let me know in the comments below. Again, if you like this video and if you find this content educational, please hit that like and subscribe button so I can bring you more ways to profit from the stock market. It takes about 4 to 8 hours to analyze and find this precious information and deliver it to you in video format. It'll also feed the algorithm to spread this video. And until next time, peace out. Bye for now.